We now turn to some technical aspects of interest rate swap pricing. In panel A of table 3, this comes off of a spreadsheet that's provided in the zip file corresponding to chapter 6. And in this particular spreadsheet, notice that the forward curve is upward sloping by 25 basis points. And this is a 3360 day count on both legs of the swap, quarterly reset. And so what we note is to get a zero mid-market value, we have to use a 535.83 fixed rate. And so, which is a weighted average of the present value of these forward rates, which we'll see later. The main insight at the moment is that if I go from 3360 on both legs to what is a vanilla swap in the LIBOR days of 3360 semi-annual and actual on the fixed leg, but actual 360 floating on the actual 360 quarterly on the floating leg, we see that using the prior equilibrium fixed rate, that this swap has a negative $1,193.68 per million of notional. And so the day count and payment frequencies has a significant impact on how swaps are priced. The second thing to notice is that for a 1-year quarterly reset swap, the value of an O1 these are annual reset swaps. So this is a 4-year annual reset swap, and so this is the 1 basis point would be $100 per year, and the present value of that would be $352. And so the value of an O1 is $352. In the case of a 1-year quarterly reset swap, the value of an O1 is basically the present value of $100, and so you end up with something slightly less than $100. So the main takeaway from this exercise is that the day count and payment frequencies do influence the results. And so if we look at an upward sloping forward curve, this time it's 50 basis points each. If we take the weighted average, if we take the weights, the present value weights, we'll notice that we weight more heavily to the front end. The arithmetic average is 625, but the equilibrium fixed rate is 621, which is something slightly less. In the case of an downward sloping curve, it's 628, something slightly more than 625. And so as a general rule of thumb, you can take a weighted average of the forward rates, just a raw weighted average, and lean it a little more closely towards the rates on the front end of the curve, and you'll be fairly close. 2-year plain vanilla, if you'll notice, the value of an O1 is approaching $200 in present value terms, so it's $191. And we again see that the equilibrium fixed rate is 10 basis points different than where the forward curve is due to day counting and payment frequency. The last spreadsheet we'll look at is a 10-year deal, and the only difference is actual 360 versus 3360. It's a quarterly reset over 10 years, and so the value of an O1 is $791, which would be $1,000, and then you take the present value of those cash flows. And so day counting makes a big difference, and the fixed versus floating payment frequencies also matter greatly. With regard to interest rate swaps, we have the day the swap is entered. We may want to evaluate the value of a particular swap at some point in time, and then there's when the swap actually expires. And so interest rate swaps, if we assume one annualized continuously compounded spot interest rate function, reasonably approximated by the LSC model, and we'll call that the spot curve. The discount factors, fixed or floating, would be simply, assuming it's continuously compounded, the fitted rate for that particular discount factor. Again, a parsimonious LSC model would be applied. The reason for this kind of model is it's intuitive, descriptive, and comprehensive, and it just flat fits the data well. Spot rates and the forward rates, if we have continuously compounded spot rates, we can compute an inferred annually compounded, discretely compounded rate with this formula. And the implied forward rate, it could be solved for. And so if we build out a continuously compounded spot curve, we can derive the forward rates that we need to input within the interest rate swap model. Interest rate swap values with continuously compounded spot rates. Again, we could write down the swap value in this form. You can check out the particular details in the text to make sure you understand the math. And again, it's just this 1 minus the last discount factor divided by the sum of the discount factors adjusted by the accrual period. We'll look at some data using 1 to 6 factor models. We'll analyze the error just to give you a feel for how this data works. This is the actual swap rates from 1996 through 2018. And we'll notice a variety of shapes. There's a downward sloping curve. This is a downward sloping curve. This is an upward sloping curve, low rates, high rates, just a whole host of different rates. If I try to fit this with a single factor, we would have just a flat curve. Concepts like duration, if you're familiar with, assumes parallel shifts in the curve. And so one way to think about that is how does the entire curve shift over time in a parallel fashion? One way to do that is just fit a flat curve. Well, the error, I'm locking the y-axis on purpose because as we add factors, it'll get more precise. And what we notice is the error rate is quite significant if we just fit a flat curve. If we take a 2-factor model, this is the fitted curve, and you can kind of tell that that's what we actually have. And this is the 2-factor fitted. It's a little too smooth, and things are not capturing all the nuances very well. And so again, the error rates that we see are quite high. This is assuming a scalar of 2.0. If I assume a 3-factor model, again with scalar 2.0, what you'll notice that the error rate in the fitted curve drops. 4-factor model drops some more, 5-factor model even more, 6-factor model even more. Remember, in finance, parsimony is a highly sought after attribute. That is, we want the minimum number of factors necessary to explain the phenomenon that we're trying to explain. We can impute a discount curve from the swap curve. It takes a little bit of effort, but we can use R code to solve for the implied fixed rate that fits the observed spot rates. And the math is provided there. If we use the 3-factor model as an example, we can solve for the implied fixed rate and using a sample of swap rates where we only have, let's see, 1, 2, 3, 4, 5, 6, 7 observations. This is a 1-factor model, 2-factor model, 3-factor model fits pretty good. And so 4-factor model does even better. And so it's clear that a 4-factor model we're able to fit not only the LSC fit, but also to derive for discount rates. 5-factor, 6-factor. At 6 factors, we start getting some somewhat unusual curve fits. If we use more refined data, I found this data on Bloomberg on a particular day, and so with more observations, we can try to fit the curve better, minimize the error, and we get the same sort of phenomenon. And so in summary, we've introduced interest rate swaps. We can price swaps based on a pair of bonds or portfolio forward rate agreements. Valuing, we can use either a single spot curve or a forward curve and a spot curve. Either way, we can solve for the particular parameters we need in order to value other swaps that don't have the same attribute. So my recommendation is, depending on what your needs are, to use either a single spot curve or fit a forward curve for your forward rates, and then fit a discount curve for your discounting, or a spot curve for your discounting, and proceed with your analysis. We'll take a quick look at the interest rate swap R code provided. In this test module, again, I recommend you just highlight the whole thing and run it. I'll make this a little bigger because there's going to be graph generated. And so if I just run this particular program, this is where we generated the errors in the fitted curve. And so this is the actual swap rates in the database. This is the flat curve. This is the error. This is a two-factor model. This is the, this is the actual rates, the fitted rates with two-factor model, the error, actual three-factor model, the error, actual four-factor model, the error. You get the idea. And so, and then the way this program works is I set the number of factors as in line 20, and then called the LSC swap curve fit routine or file. And in this particular file, I set some subtitles, the information that's going down here, and then actually, depending on the number of factors, I'll estimate the factor coefficients. And then again, depending on the number of factors, I'll run the regression, save the coefficients to whether it's number of factors of 1 be the intercept, 2 would be intercept and slope, and then intercept, slope, and curvature 1, and so on. And so this particular routine just estimates the fitted curve, and then computes the fitted rates, and then estimates the error. There's another test program in this particular module, and this particular module where I'm going to estimate the discount curve directly. And in this particular program, it fits the discount curve, and then I look at the LSC fit. And this model works fairly well. I wanted to also quickly highlight the fact that in the LSC swap curve fit routine, if you pick up on line 234, I'm basically working with a set of data, and I send it out to a spreadsheet depending on how many factors were selected. And so what you'll notice is there are outputs sent out to a spreadsheet. Often some end user wants a particular set of output in the spreadsheet, and this is a really nice way to do it. And so if you wanted to do an analysis of, say, the three-factor model versus 4, but you didn't want to do it in R, you could do it in a spreadsheet.